Hey everyone, it's Ruby here on the Nadlin Forum Podcast Daily. Today we're diving straight into something that's, suddenly back on everyone's radar, core inflation. So July's core PCE inflation jumped up to 2.9%. That's actually the highest it's been since February, and it's crept above the Fed's 2% target again. And look, I know people get confused with all these inflation numbers, but core inflation is sort of the one economists keep banging on about because it cuts out food and energy. So you don't get those wild swings when petrol or milk prices bounce around.
Exactly, Ruby. It's interesting because even though the headline inflation sometimes scares people, most analysts think core is a much better way to judge what's really happening underneath the surface. This time, we saw a pretty sharp split. Goods prices were only up about 0.5% year over year, but services like insurance, healthcare, rent, services shot up 3.6%. That's a big difference. And in the US, a lot of spending is on services. It's really what's been propping up that number. So you're not wrong. The focus has shifted more to core, and the pressure is definitely on the Fed now.
And honestly, you feel it before you even read the stats, right? I remember this was maybe last spring. I'd tried to do one of those, can I survive on $20 a week? Budgeting challenges in Sydney? Big mistake. All was going well until one morning I'm grabbing my usual flat white and boom, overnight, it jumps up by 50 cents. That's a huge deal when you're counting dollars. It's like the news says 0.3% month over month, but it always hits you in the little routines first. Where was I going with this? Oh yeah, price increases, especially on services. They mess with your day-to-day plans before you even notice the national numbers.
Yeah, for sure. And what's funny is that a lot of people just notice one thing, like coffee, or maybe their streaming bill going up. But those numbers add up. And that's what the Fed's looking at when they talk about raising or lowering rates. Speaking of, let's move into what all this means for spending and households, because that's where I, as someone who works on the finance side, get the panicked phone calls. So incomes in July went up 0.4% and spending jumped 0.5%. Honestly, that's pretty strong. Even with prices ticking higher, households still went out and, shopped. People aren't clamming up the way you'd expect if they were really feeling the pinch everywhere. And you think, all right, the Fed is staring at inflation, but the market's sort of betting they're going to finally start lowering rates. But the employment numbers, those tell a different story each month. It's a little like watching a tug of war, Which one's going to tip the balance for the Fed?
Definitely. You see it in the news. One day people are dead, certain rates will drop. The next, they're like, wait, maybe we're stuck for a while. Actually, you had a client story the other day, right? Someone stressed about making mortgage moves with all this uncertainty?
Yeah, exactly. So, I had this client, young couple, both work in tech, solid jobs. They're watching all the headlines and they're basically frozen with indecision. Do they lock in a new mortgage now when rates are kind of high? Or do they gamble and wait to see if the Fed cuts in September? The problem is consumer spending is up, but at the same time, inflation isn't falling fast enough. So from the investor side and for regular homeowners, it's hard to plan. You almost have to plan for every possibility. And as we talked about a couple episodes ago, this sort of uncertainty just bakes in more unpredictability in the real estate space.
Oh, absolutely. And it's funny because the market wants to believe the Fed will give everyone a break. But as we found in that episode about the Fed's inflation dilemma, they're balancing so many things. If the labor market weakens, they might cut rates just to keep everything afloat. But if spending stays strong and prices don't chill out, they could easily hold steady or even, gasp, raise again. It's so hard to know which way it'll go next month. All right, moving to the global side for a sec. Trade policies making everything trickier too. Earlier this year, the Trump administration put in a baseline 10% tariff on all kinds of imports and axed the old exemptions that used to keep costs a bit lower on smaller items. That sort of thing absolutely filters down, and over time, it just pushes costs higher for consumers.
Yeah, and you're seeing that in the inflation data. Goods prices are up a little, but anytime you add or expand tariffs, especially on materials, like the stuff developers actually need to build, that's more expensive projects, maybe even delays if costs keep climbing. The market sure wasn't thrilled after the latest PCE report and tariff news. Stocks turned negative right away, and Treasury yields just stayed stubbornly high, which, again, shows everyone's anxious about the next move.
It's the ultimate hurry up and wait, isn't it? And if tariffs get bumped even higher, that's going to hit imported construction materials, appliances, a lot of the stuff that makes new housing or even renovations possible. Real estate developers, and even just your average home renovator, could end up paying loads more. Could actually slow down some projects if budgets get blown out. And then, like we saw in last year's trade spats, prices for finished homes could creep higher too.
I completely agree. And if these trade tensions escalate, you start to worry about inflation feeding on itself. Higher development costs, slower supply chains, tighter margins, and eventually, less new housing coming online. It's a bit of a feedback loop, and that all trickles back to the homeowner, the investor, the renter. So, markets are right to be cautious.
Look, we'll keep tracking all these threads. Core inflation, spending, the trade knock-ons. There's always another policy change or market surprise coming, right? If you want more tips on planning moves when the future's murky, dig into some of our episodes from last week. But for now, I reckon that's all for today's show.
Thanks, Ruby. And thanks to everyone for listening. We'll be back soon with more on real estate, mortgages, and what's next with these economic shifts. Don't forget to subscribe and reach out with your questions anytime.
Cheers, Leo. Catch you next time. Everyone out there, stay curious. Bye.